1932, protecting the future of working families. Teamsters, 1932.org.
You're listening to an encore presentation of this program, KCAA, the Inland Talk Express.
Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, listening to us. We bring to you the information of the day, and today is chock full of it, at least this week has been. We have the Fed meeting as well as the CPI data that has come in. But before we get to any of that, Jeff Barton, the Mortgage Voice, is on YouTube. YouTube is our home away from KCAA, our radio station that we broadcast in the Inland Empire. KCAA, we've been on that station, 8-9 years. We love what they do. They bring us to you at the IE, San Bernardino and Riverside counties. And as you all know out there in those particular areas, getting mortgage information that you can rely on is difficult. You either got to know an uncle, you got to know a friend, you got to know somebody who is recommended to you. But here it's unbiased. I'm just going to give you what I think, and I've been in the business 30 years plus. So it's not gospel, but it is as close to what I think today is about, which is trying to give you accurate information that you can use and act upon, and that is in itself good enough for most people. Take what it is, go out and find yourself a terrific mortgage broker or a real estate agent or both, and then go house hunting. There is some good news in the house hunting world anyway. Again, I'm Jeff Barton. This is the Mortgage Voice. In the house hunting world, yes, we do have inventory that is up. It's been up about the last 5 months in a row after being less and less each month for the previous, 17 months. Now, we got a long way to go to catch up to where we were in 2019 pre-pandemic. Reason is just because that pandemic, I'm telling you, it set the real estate, the rental market, as well as the purchase market on its head. We had such low rates that everybody bought. Nobody wants to move now because you'd be crazy. They call that the lock-in rate and the lock-in problem. We used to get a lot of different buyers and sellers in the marketplace that would just want to move. They wanted a bigger house, or they wanted a smaller house, or they wanted to move just because it was time to move, or they got old and they wanted to downsize, or they wanted to upsize because they got more kids. There's many reasons why in the market prior to, we had a lot more movement, a lot more housing on the market, and therefore prices weren't as high as they are. But as rentals became what they became in distant cities when people could work from home or had to work from home, we saw a trend develop, which was inflationary spiraling of real estate costs. And those costs are today continually reflected, not because of the pandemic or people moving away from the inner city, because most people moved back, but because less houses were built. Now, we try in the industry to highlight that to people, to let them know that, hey, you know what, there is probably 1 million less houses per year being built than should be being built. We probably have a demand of, a good few million, if not 10 million deep, i.e. People, supply, demand being what it is. If you want something and you want to pay for it, you'll pay more than what it's actually worth in order to get it. That is the way it works. Well, right now we have a situation whereby housing prices are so high, we're getting more houses staying on the market for longer. We're even getting a small percentage, 25, 30% of houses on the market actually in price reductions. But it's a deceiving term, price reduction. What does that mean? You overpriced it by 30% and you dropped the price by 15%. So that means it's still overpriced by 15%. That's what's happening in a lot of areas. But again, as I said, this is what's happening both here in Southern California and nationally. So this is a problem that exists all over the place. Okay, let's get right to it. As I said, I'm Jeff Barton, Mortgage Voice. Here we go. 30-year fixed rate, 6.98%. 15 years at 6.40. FHA is at 6.42. The jumbo is at 7.25. and the VA loan is at 6.45. The 2 years at 4.748, and the 10 years at 4.308. Yes, if you are listening to me week after week, you'll realize and recognize rates went down. And yes, that meant that there is more activity in the mortgage market. Mortgage applications ticked up quite a bit this week just because the rates dipped a little. As you see also that the treasuries, the 2 and the 10, there's still about a 35 basis point spread between the two to the negative side, meaning the 2 is yielding more than the 10. However, those particular 2 bullet points, or whatever you want to call the information, they don't mean much as they used to. It used to mean that if you had the 2-year, which was priced more or yielding more than the 10-year, we were in recession's harm way. Well, we're not there anymore because we're over 2 years into this. I was listening to Bloomberg Radio on the way to the show, and I love that, by the way. It's a great radio station. It's on Sirius. I don't know if they have a local feed. It's not like KCAA where you can turn on your radio driving around on Saturday and Sunday and listen to us. But Sirius has a great Bloomberg feed, and Bloomberg's on your computer. So if you do listen to it, you'll understand what I'm talking about. They were talking all about this as well, in how the 2 and the 10 mean nothing anymore. It's as if that particular portend of the future just never existed. Now, we'll have to see, but there's no recession on the horizon. If anyone heard or listened to Jerome Powell talk about what's happening with the Fed, and again, the Fed has remained, again, I didn't even tell you, the Fed has remained the way they are. They are going to keep higher for longer, 5.25 to 5.75, 4 member banks to borrow from them. That's a benchmark interest rate that obviously is going to show up in your credit card payments, your house, not your house payments, but your car payments, credit card payments, and certainly any kind of auto loans, all that kind of stuff is going to be reflected by what the Fed has as their interest rate. Now, as mortgage rates, last week we tried to ferret out for you and let you listen to an explanation of why mortgage interest rates are what they are and why they watch so closely what the Fed does. And I said it was all about competition between what was being bought on the debt market, whether it's mortgage-backed securities or whether it's the treasuries. Those two have to compete. They have to compete on price. They have to compete on yield. And when that, in effect, is controlled by a arbitrary Fed number of 5.25 to 5.75%, you are not going to see a lowering of the interest rate on the mortgages that much, although they did come down some. So as we said, we're below 7% again for the 30-year fixed, and that is good or good enough for a lot of people. Now, historically, 7% is pretty good interest rate. As I've said many times on this show, 8.75 was my first loan I got back in 90-something. And that was, I was very happy to get it at the time. Now, granted, there was much more inventory, and the price on houses wasn't as high as it is today. The price on houses is really amazing. But let's get right to a little bit of the CPI. That's the Consumer Price Index, which happened to come at the same time that the Fed was meeting, and the Fed said that they were going to remain higher for longer. CPI, inflation, didn't go up as much as people thought it would. It basically was flat. In May, it was 3.3%, and in April, it was 3.3%. In May, it was 3.3% also. Therefore, the markets, stock market, usually that's what we talk about, was happy, and it went up, and it went down, and it went sideways. But what it didn't do was panic and have an explosion like it did last month, because we saw a little bit of a raise in the interest rates, in the inflation rate in March and in April. Stock market didn't like it, but right now we're seeing a long-term trend of slowing, ever so slowly, the inflation rate. Now, I have a few products here that I wanted to just describe to you. Some prices going up, some prices going down. In the up section, shelter. Shelter was the biggest, what they call the unsheltered and the shelter index, whether it's rental or purchase. Both of these particular items are about 50 to 60% of what the inflation rate is. So as these prices continue to go up, that's a problem. We need to see housing prices come down. As I explained earlier, unless we're building more, it's a supply and demand issue. And yes, it's It's not an easy thing to solve immediately. A couple other things. Auto insurance is up. Restaurants are up. Transportation and groceries are also up. On the downside, gas is coming down. Used cars, rental cars, airfares, hotels, and new cars as well are also coming down in price. So there is some good news in this inflation report. We need to see more of it so we get the Fed to cut, so we'll see tangentially mortgage interest rates come down too. We have a jam-packed show. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, listening to us on a weekly basis. We try to bring you the best information that you can use on a daily. We always do that by keeping you in mind. You want to know where the houses are, where the cheapness is, when interest rates are coming down, is my job going to last forever, when's inflation going to stop? Yeah, there's a lot of stuff that we touch on this show. Answers, not so much, but we certainly bring up good quality discussion in all of these areas. Joining us once again is Connie Hernandez from PMA to answer all of those questions, because I know she has the answer. Connie, how are you?
Oh my gosh, thank you for that amazing introduction. I sure hope I have all those answers.
Well, you know what? How about let's just work a couple of them. I know that we're in early part of the summer or late spring, and we always think that time of year really sets the tone for the rest of the year because supply and demand and housing prices and all that. People are either moving or they're not moving. They're buying or they're not buying. Where does it stand out in Covina and the Inland Empire?
Well, unfortunately, I'm sure that real estate agents are seeing this everywhere. We still don't have enough inventory, right, Jeff?
Right.
We're still struggling to put our clients into homes. But on the good side, we are busy on our real estate division for real estate, and that obviously helps us with the loan side.
Sure.
I'm kind of been around for a little bit, probably close to as long as you have. And
you didn't mention a number, though. All right, it's okay.
Well, a little bit, right?
Yeah, a little bit. Yep.
Well, with that being said, we're looking at new opportunities. Obviously, we built our business on old technology and handshakes and meetings and seminars, and I think now with the new systems in place, social media, we have to really strongly look at those avenues. I think door knocking is still okay, but it's just not the whole answer anymore. We really have to be a bit more innovative on how we run our businesses. Obviously, we would love to have our business like it was, 4 or 5 years ago, but
sure,
that's not the case. The interest rates haven't budged, so that means we have to make some changes on our side, right?
Right. No, I think what you're saying makes a lot of sense, especially in our business, especially with the lawsuit that, NAR stumbled into, and now all of a sudden a lot of buyers agents are finding themselves in a completely new field in terms of how they represent clients, or if they can even get paid if they represent clients. So there's a lot of changes there, too.
There is, and I think that it's a very devastating situation. I mean, obviously, those agreements have always been there. It's just they haven't really been used. And because it's always been a customary thing that you're a listing agent, that you're going to be marketing to buyer's agents, and with that, sharing the compensation. But that still, in some situations, I think will continue. I don't know for how long, but it does put a sense of unease, and I think for the agents that are mainly representing buyers, but really that's going to put the buyers in a very difficult situation because, as you know, our job as a fiduciary agent, we have to represent the sellers if that's who we're in contract with. And we have to also disclose, if we're listing a property, that our fiduciary relationship first and foremost is to the seller. So where does that leave the buyer as far as representation? That's kind of a scary thought that I think maybe was not thought through.
I think like many things, if you just put your head down and get a pillow and put it around your ears and don't look around, all of a sudden the problem goes away. I think for the most part, the issue here is simply that the buyers have never paid. I mean, they have, I guess, if you consider that they're paying for the property and the seller takes the property. But this has left a big hole in representation for the one person in the transaction who really needs it, which is the buyer. Because the buyer doesn't have extra money to pay you. That's never going to happen.
Well, yeah. Absolutely right. You think about all of the first-time home buyers that are struggling to, capture that American dream, right?
Yep.
The home ownership dream, and they're putting their, for better lack of words, their savings together and maybe receive some help from mom, dad, grandma, family member. And, putting that down payment together, putting those closing costs together. I mean, the DPAs have their challenges, I believe. I mean, they're not for everyone.
Right.
So the thing is, if they're struggling to put those funds together, how now are they going to pay to have someone properly represent them? I just don't see that happening.
No, you're going to get lowball offers. You're not going to get paid what you're worth. There's going to be a two-tier system in how real estate agents are viewed. Oh, you're a buyer's agent, so you'll work for anything. I mean, that's the mentality. I'm a seller's agent. I'm going to get 3.5% every time I, sell a house, because the sellers, the listing agents themselves have an expertise, and they do. That's what they do. Now, like us, we do both. So we're kind of like, okay, part of my business is not going to do well because I never used the contract and I always got paid. And the reason I always got paid is the main pitch is I don't pay you. You don't pay me. The seller pays me. And therefore, you don't need a contract. That's a simple 5-second. Don't worry about it. I'm going to work for you. I'm going to kick butt. And at the end of the day, it's going to cost you nothing. That's a great sales pitch. I mean, now I have to go completely the opposite, saying, well, here's my list of qualifications and why you should be paying me 3.5%. I mean, come on. That's and nobody addresses it. It's like it doesn't even exist when you talk about it.
No, it's kind of like being brushed under a rug, and I really don't. Unfortunately, I haven't come across a situation where the listings haven't had compensation for the selling agent yet.
Right.
But that may be coming, maybe not. But regardless, the rule is there, right? So we have to address the rule.
You have to do it now. It's not a choice. It was an agreement not made by me. I don't have a union. This was made by an organization that was trying to bail themselves out of getting sued, and getting sued to the tune of $1.4 billion. I think they already have to pay. Oh, come on. You know that they were selling somebody out, and it happened to be the buyer's agents. That's what happened, because the seller's agents and the seller's agents companies that represent most sellers, that was the best way that they could figure out how to deal with this, So, in my opinion, it'll work out one day, but not today. That's for sure.
Unfortunately, yes. Maybe not in our career time, but maybe our next generation, hopefully.
Yeah, maybe. And I think there'll be some added services that the buyer's agent should be able and allowed to do, which won't necessarily have to, cut into the bottom line of the seller, but at the same time, make some money. I mean, menu of services, value-added services, something like that. Anyway, we have about 2 minutes left. I wanted to get to a couple of loan products that maybe you're, happy to talk about in terms of what your business is geared towards.
Well, right now we're actually doing a lot of DSCR loans, and not just for purchases, although that actually has picked up quite a bit, but more for the refis. We've actually had an inflow of business for the DSCR loans, and those seem to work out really well. They're a bit easier to tackle. Clients know that they're paying a bit higher interest rate for them, but the fact that they don't have to provide a ton of documentation is the big reason why they go forward with it. Plus, in some cases they are doing cash out, reinvesting that money elsewhere, other properties or other investment opportunities. So I think right now our big focus is on the DSCR loans, although obviously we still handle all the other products. We have a trickle of business coming in for buyers that are still doing the FHA, the conventional
Right.
minimum payment loans, but seems to be a big push now in our office for doing more commercial type loans.
Yeah, you know what? That's because it's tridless. It's like you say, less documentation. It's more about bottom line. What's the down payment? Let's get into what the rents are going to be so we can figure out exactly where the gap is and then fill that with whatever other information they might need. It's just a simpler, easier way and less liability. That's what I see.
You're correct when
Right.
you say that.
Right. Hey, Connie, we're at the end of it. Thanks for coming on. Could you shout out a way by people can get in touch with you, especially if they need someone with not only knowledge and experience, but who really does care about whether you're going to get in a house this year?
Oh, I absolutely do. Thank you, Jeff.
You're welcome.
You can reach me where our office is on the corner of Badillo and Citrus in downtown Covina, 101 North Citrus. Our office number is 626-918-2419. My direct number is 626-422-2017. I would love to answer your questions and help you with your loan needs or real estate needs.
Excellent. Connie, thank you very much for coming on the show. I really appreciate it.
Thank you, Jeff.
You're welcome. That's Connie Hernandez from PMA. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, listening to us as we bring to you the best information out there in the Inland Empire concerning mortgages and real estate and ways by which you can get into a house this summer. I know the prices are high. I really do. I know that the mortgage interest rates aren't coming down. Well, they came down a little bit the last couple of days, so that's a good thing. Fed met and inflation came down, the CPI. So there is some good news out there. Certainly, we're trying to get through a very, very hot summer. Joining us once again from Nations Direct is one of our best go-to people, really knows the industry well, is April Lopez. April, how are you?
I'm great, Jeff Barton. How are you today?
Thank you. Nobody ever uses my last name but you, and I appreciate that. I'm great, too. Thank you.
Wonderful, wonderful.
Okay, give us the skinny on what's happening at Nations, where the business is, if there's business, and what you foresee over the next couple of months in the summer.
Absolutely. You know, it's kind of interesting. We are seeing a big uptick in submitted business, despite the rates, have been kind of going up and down. We saw a little bit of a drop the past couple of days.
Right.
And then interesting enough, today the Fed spoke, said they were making no changes, and then we got a worsening of price about an hour ago. But I'm telling you, there's a lot of people who finally just accepted the fact that the rates are where they're going to be, because we definitely have an influx of business that is keeping us busy.
Oh, that's excellent news. And is that a national trend, or is that more Southern California?
I think it's actually outside of Southern California.
Okay.
I think it is. I think it's definitely national. I see a lot of the submissions coming from the Northeast and the Northwest.
Okay.
And in those geographical areas, I think that those homes are more affordable. We're seeing a lot of government purchases, along with a lot of just first-time home buyers that are taking advantage of some kind of, benefits on the government's low-level price adjustments for first-time home buyers whose average median income is within 120% of those dictated values.
Okay, explain that a little bit so people have a better understanding.
Absolutely. So the government came out and they said, based on the county, the census tract across the nation, they have put together a grid that says the average median income for that census tract hypothetically is $100,000.
Okay.
If you are a first-time home buyer and you are within 120% of that $100,000 of income, so if you make $120,000 or less, then we want to make the loan more affordable. So we're going to reduce the adjustments to the rate for that new first-time home buyer on those parameters, which means at a low down payment, instead of you having an adjustment of 2.25%, your max adjustment will be 1.5%, which means your cost to take out that loan is going to be less.
Yeah, it's about $1,500 to $2,000 in that range on a $100,000 property or something like that. Anyway, that's very good. And is this the type of product that's being taken advantage of in this national view?
I absolutely think so. I think that the big players like Quicken and UWM and us, middle-sized lenders, we are definitely taking advantage of that. And Fannie and Freddie are also, and predominantly Fannie, they're giving first-time home buyer grants to the banks like the Quickens and the Nation's Directs. So we're going to roll it out within the next 60 days, where if you're a first-time home buyer and you are getting a conventional Fannie loan, that you're going to get the ability to have a $2,000 credit towards your closing costs. And that's already been implemented across the nation with the larger banks who already have that in place with Fannie and Freddie.
Do they consider real estate agent commission closing costs?
That's still on the table.
Right.
So we are thinking it's not, because it's part of the real estate transaction. Mm-hmm. But since that's going to be rolling out sooner than later, we're going to get more definition on that. But we don't think so. We think that's going to be separate, aside.
Okay.
And I do know that a lot of people have been asking, well, will the lender be looking to roll in the cost into the loan? So talks had come
cost
up
of the real estate
about
commission is what you're saying, right?
Absolutely, yes. Right. So if Fannie and Freddie and the government agencies deem that is the cost of doing the loan, then I'm sure you're going to find that those programs are going to start rolling out where we will be able to finance that into the loan.
Yeah, that's because it's the only way really buyer's agents are going to get paid. I spent a little bit of time off air and during the last segment talking about it and how really it's flipped the industry, and a lot of people just don't know what to do. NAR has not really been a help, and CAR follows NAR, so you're really on your own if you're a buyer's agent and you really have no idea what to do in order to get paid. That was one of the suggestions, but again, it's got to be litigated. It's got to be, you know how things take so far and so long to get completed. Anyway, that's why I was just trying to ask you to see if that was part of the bank's policy. What else? What's happening in terms of refinance? Refinance is dead, right? I mean, nobody's doing that.
So yes, no one's refinancing their first trust deed. However, we see a ton of second mortgages right now. So I'm doing a lot of second trust deeds in Southern California.
Full second trustees, not HELOCs or anything like that.
Correct. Full second trust deeds, fully amortized over up to 30 years. And they're closed in, so they're not HELOCs. And I'm seeing those more in Southern California because of the loan amounts, because we have a minimum loan amount requirement.
What, 150, 100,000? How much is it?
Well, actually, it's $75,000, but you're not going to get paid at $75,000. So it's really difficult for the brokers to even get a commission under $150,000.
Okay, I understand that. You mentioned Rocket and you mentioned UWM, the big players. How are they lasting in this thing? They must be getting killed.
Well, it's interesting. I think that they, as far as refis, yes, but, they have so many different incentives to offer the new home buyers that when I was reviewing Scotsman's Guide and I was looking at the top loan officers in 2023 along with the current ones, 80% of California's business, it's actually 88% of what we see is going to the Quickens and the Rocket just because of innovation, speed. They take on a lot of the costs, ordering verifications of employment, condo questionnaires, things that are a lot of cost to the borrower. And as you can see now that CFP have come in and said, hey, we want to investigate now on how we can lower fees for the consumer. So they're looking to crack down on that. But because these bigger entities have the ability to absorb those costs, they also have an inside insurance company for MI. So, so their MI is lower, so that attracts more buyers because their mortgage insurance can be anywhere from $30 to $100 less than maybe sending that loan to myself, where we use the top players in mortgage insurance like MGIC and Essence, but our rate is just a tad bit higher.
Yeah, you know what? I just don't see how a company like that, these are just the biggest companies in the country, how they can stay afloat or how they can, last through a downturn time. They must be losing per loan, have to be. I mean, all the smaller companies, everybody's treading water to wait for the next refi boom.
Yeah, I mean, they definitely took a hit because I know that, they've, and they're trying to pick up on the non-qualified mortgage sector of loans, so they are trying to do that, but they have scaled back, but they still are taking the larger piece of the pie nationwide. Right.
Okay, we have about a minute left. Give me your idea as to what we can expect this summer, both in rate and product from Nations.
Well, I think that our rates right now are top on Loan Sifter, so you're going to see Nations being very aggressive in price. Nationwide, the rates are going to stay stable. I don't see an increase or a decrease of anything significant until after the election, until the first quarter of next year.
Yep.
So, and, we're just continually being aggressive, getting those loans closed and getting to the finish line as fast as we can.
Excellent. Thank you, April. Thanks once again. I love having you on the show. It's easy, plus the knowledge is great, and I really appreciate that. Would you shout out what your phone number is so people can get a hold of you if they need you?
Absolutely. April Lopez, 818-398-1272.
Excellent. And that's April Lopez from Nations Direct. April, thanks very much for coming on the show.
Thanks for having me, Jeff.
All right. Bye-bye. I'm Jeff Barton, your voice in the mortgage industry. Be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us. If you listen each and every week, you'll realize that very quickly, not only do we bring up topics that are important to decide whether you're going to buy and sell real estate, but it's also at the heart of what is happening in our industry. There's so many changes. In the real estate side, we talked about the commissions and who's getting paid and why there's no support for certain types of transactions. On the lending side, of course, are people getting used to the 7% plus, or are they into just getting into the property for whatever it is that they can do and then worrying about the rate later? I think there's a lot to be said for both, but I'm not the guy with the answers. Come on. The guy with the answers is Charles Giscombe. He comes on the show a lot. He talks about what's happening in the lending world, and he joins us once again, to help us sort through it. Charles, how are you?
I'm doing great, Jeff. Thanks for having me today, my friend.
Excellent. The Boston Celtics of the lending world has joined us, and we really... Did you like that? Throw that in there a little bit?
I love how you toss that in there. Boy, it takes a Boston guy to really glue all that up, folks.
You know what? I know my audience here in Southern California, San Bernardino, Riverside counties, I know you're all Lakers fans, and I'm sorry, but I don't know what they're doing with their coach. I don't know what they're doing with their players, but they still got a team that you'll watch because that's how it works. But speaking of building, team building or building, what kind of loans you doing? Are you still into any kind of DSCR? Is it mostly commercial? You're putting deals together all the time. Give us a synopsis of what's happening in your lending world.
Well, Jeff, I have been fortunate to working with Malibu Funding and United Security Financial and different companies to be able to do a different and a plethora of loans. Besides traditional lending, we obviously can offer commercial lending. The traditional lending has been slow, but it's been steady, and interest rates have been high until today.
Right.
When the data reports hit, the inflation shows it's down, and guess what? The mortgage rates are lower, and so now you have some loans that are under 7%, which is probably going to create a buzz in the market. The one thing that we have steadily done on our side is to make sure we find loan products that will be able to help individuals regardless of our rates are up, rates are down. We're looking for non-QM loans that take the place of traditional lending. They have a little bit higher interest rate, but there's value-added services to the back of these loans, meaning ARMs or meaning longer amortization terms, 40 years, that will lessen the monthly payment. And that will keep people steady and keep them focused and excited about the industry at this point. And so that's the type of loans that we've been doing. But of course, we do traditional loans as well as commercial loans, no doc loans, bank statement loans. All these types of loans are out there in the lending world for individuals who want to take advantage of the market still.
You know, you talked about being a little bit of not a fixer, but somebody who could make things happen, i.e. you have solutions for a lot of difficult customers and a lot of difficult loans. However, some people do think that as you said earlier, that there are miracle workers out there, that they can just poof, all of a sudden you got the money, make the deal, and you can't either prove credit or you can't prove, any way that you can pay the loan back. What are some of the ways that you can help a buyer understand that there are responsibilities that you can take care of, but there's certainly many that the buyer has to do themselves?
Well, I was joking earlier, but I really mean this, folks. Under the tutelage of Master Yoda Jeff at Malibu Funding, I learned very many skill sets. The one good thing about Malibu Funding and Jeff in particular was Jeff kind of had us all be Swiss Army knives. When I say that, is you're going to have to deal with different individuals, different problems, different hurdles that you're going to have to cross at all times. And having a lender or a loan officer or an originator in your corner that has dealt with all these different things is super helpful. The one thing that we have the ability to do at Malibu Funding and at United Security Financial is speak directly to underwriters. A lot of times what we would create was an environment that allowed us to take the situation or issue that other people may have had or they think they're going to run into, introduce those up front. We can cross those hurdles and know that the hardest part of the transaction we were able to bridge across. So now everything else should be business as usual and get that situation done. Blessed to have those relationships, blessed to work with different lenders that offered us that opportunity. And so a lot of times what I tell our clients is because of our relationships, because of our history, our resume, our experience that we have, we're able to talk to individuals, talk to different underwriters or processors and get some answers to some questions ahead of time so that we know that we had a loan that we could work on. It doesn't mean that it would take any less time. It just means that when we cross that bridge or hurdle, we knew that we have an answer for it. I think sometimes preparation is best up front so that later on in the loan, when we're crossing hurdles and bridges, we can get past them.
Yeah, and what you're talking about is, hey, if there's maybe a problem with how we present this loan, we got to have an answer. Now, it doesn't mean that there is something wrong with the loan. It just means that as you present the information to the lender, that those issues that might come up, maybe they need another year's of bank statements, maybe they need some other proof of income, maybe they need you to pay off some debt in order to get your credit score up. All of these things are things you talk about up front. That's what you're talking about.
Absolutely, Jeff. I always tell the clients, because I create a relationship and I want to create a rapport where they can speak directly to me and transparently to me as I can to them. Don't tell me what you think I want to hear.
Right.
Tell me all the stuff I need to hear because I'm licensed to paint the picture and tell the story. So please, give me the information and I'll make sure that I create the workaround and so that the different professionals that I'm dealing with will understand exactly what the issues are so we can tackle them. That way we don't get bombarded at the end, towards the end of a loan when everybody's super anxious and
right.
The pressure's on, and all of a sudden now the deal blows up. But no, we brought the bomb dog out ahead of time, and the robot took it apart.
Yeah.
And now we're good, so we can pass through.
No, that's true. And what I was thinking about prior to you saying that was the lenders that we talk to or the people that we've known also, and placing your loan in a certain lender's hands on the brokerage side is a way by which problem solving gets easier, just because not that one lender is easier than another, but if you've got a certain type of loan that a bank or a lender really does really well. That's who you want to go to. If you want speed, you go to a certain type of lender as well. If you go to the Rockets or the UWMs, but you have to have a loan submitted in a certain way because you know exactly what they need in order to get the speed you need. So that's really kind of important that you, as the loan officer, have that information for the borrower as well.
That's the important aspect of being a loan officer and an originator.
Right.
Membership has its privileges.
Right,
There
right.
are certain banks that we deliver so many loans to and have been for years, Jeff and the team for many of years, is that we understand we're responsible, we're accountable, and we're trustworthy. And at the end of the day, they know when we bring a file to the table, we're going to know the ins and outs of that file so we can all surgically pinpoint where the problem's going to be and we can resolve it. Because understand something, in this industry, problems happen all the time. It's how quickly and effectively we resolve them as the loan originators that get these deals done and across the finish line.
Yeah, no, all that is so true. I mean, I see people who are struggling, and I go, what's the problem? Well, you know, we were supposed to close by X date, and looks like we might not be able to. I said, oh, okay, I understand. But you hear that, especially in a market like this where there's so many people competing for houses, you have to have an ability to be able to not only move and solve problems, but to be able to identify those things up front and to be able to compete with other, you know, loans that are out there competing for that one piece of property that you want to buy.
Jeff is absolutely correct. I love to talk about it. Basketball has taught me a number of wonderful different things and taken me many places around this country and around this world. But the one thing it has done best for me, it has taught me how to problem solve on the fly. Mm-hmm. And I'm grateful for it. And it all comes in handy when we're working loans out with our clients.
Excellent. Charles, we are at the end of it. Thank you very much once again for coming on the show. Love having you on, and we'll have to have a party once the Celtics wrap this thing up in a couple of games.
Oh, I told everyone, Jeff will find a way to add the Celtics to the equation at all times, and I love him. And he is right. And pleasure to have me. Thanks for having me on, Jeff. It's always a pleasure.
No problem. Shout out your phone number for people if you would.
I sure will. You can reach me at 725-577-8761. That's 725-577-8761. Or C. Giscombe at usfwholesale.net. That is C. Giscombe at UncleSamFrank.net.
Excellent. Thanks very much, Charles. Thanks for coming on the show.
Thanks for having me, Jeff.
That's Charles Giscombe from USF, United Security Financial. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, listening to the show as we come to you each and every week. KCAA is the radio station that brings us to you. We also are on a number of different podcasts, and those podcasts, Daryl, do you have a list of those?
I sure do, Jeff. It's Apple Podcasts, Google Podcasts, Spotify, Spreaker, Stitcher, iHeartMedia, Odyssey, YouTube, Podclips.io, and, of course, themortgagevoice.com.
Excellent. Mortgagevoice.com, by the way, is our website. If you go there, you can see and hear a lot of the guests that come on the show and a way by which you can contact them directly. Podclips.io. I pitch them every week. Why? Because they are great, and you can go there for your central podcasting needs. There's all kinds of different areas within the podcast group. I'm one of them, of course, Jeff Barton, the Mortgage Voice. And there's, there's lifestyle, there's sports, there's ADR, there's, what are some of the other programs on there, Daryl?
Well, they get sports and they have finance, and you mentioned lifestyle. And arbitration, the ADR is arbitration.
Oh, yeah, the arbitration. Right. You know what? In our business, sometimes it comes down to being able to find somebody to bridge the gap between your side and the other side, other than hiring lawyers and suing each other. Well, these guys at ADR do that, and they are on podclips.io. Great place to go.
And, of course, health.
Health, oh, yeah. Absolutely. Anyway, I'm Jeff Barton. This is The Mortgage Voice, and thank you for listening. We have a long list of great people that come on the show. We really do. We've been doing it for a number of years. The expert in the reverse mortgage side of the business is only one person. It's Nina Penny, and she joins us once again. Nina, how are you?
I'm doing great, Jeff. Thanks for having me.
Thank you very much for coming on the show. Okay, reverse mortgages. There's age limitations. There's the amount of money that you can take out of the property. But give us some of the just general benefits that somebody's going to get if they get a reverse mortgage, and try to dispel some of those horrible things that they used to say about them that aren't true anymore.
Oh, that's a lot right there, Jeff.
Right. I know.
So, basically, the reverse mortgage that we have today is really not the reverse mortgage of our parents.
Right.
It is not that loan anymore. Since President Reagan was in office, he really made these reverse mortgages a lot more senior friendly.
Right.
Basically, today, a reverse mortgage is simply an FHA loan that you're not obligated to make payments on. Can if you want, but you're not obligated to do so. Right now, what we're seeing in the market, a lot of people are liking a reverse mortgage because even though the interest rates are higher, if they take out a reverse mortgage and they don't need the funds today, every reverse mortgage has, adjustable rates have a line of credit, and that line of credit increases the amount of money they can tap into. So if the interest rate right now is 7%, that growth rate is going to be about 7% as well.
So, okay, so in a reverse mortgage itself, there are a couple of ways that you can tap into the equity that's in your house. Now, a lot of seniors own their own house outright, which is a good thing, which means that they have at least 50% of the value of their home might be available to tap into at whatever way you said. You said it one way it can be a kind of like a HELOC, and the other way it's a lump sum. Explain the difference.
Well, okay, so on the adjustable rate, how you take your money is totally up to you. If it's free and clear, you can take the money, some at closing, and leave some in a line of credit. You can take it kind of as an annuity payment, payment every month. You can take a specific amount of money for a specific amount of time. Now, on the fixed rate, it's a lump sum at the time of closing.
I see. Okay.
Mm-hmm.
And
so it really depends how you want to use it.
Is there I live in a very expensive town, and my house over the last, 4 or 5 years has really gone up in value. Now, we paid off our mortgage about 8 or 9 years ago. So of that amount of money that is just really, I'm property rich but cash poor, as a lot of older people are, tapping into that money, how much money can you take out? As much as you can, or is there a limit to it? Tell me about that.
Well, okay, so a reverse mortgage, how much you would have access to is dependent upon, number one, the appraised value of the home, and number two, the age of the youngest borrower. We want to make sure that all numbers are based on the younger person living at the home, because we want to make sure that if something should happen to the eldest borrower, that they're still protected. So we're not 100% financing. What we would have to do is run numbers to tell you exactly what you would have access to. Let's just put it this way. The older you are, the more money you would get, because we have to use some number as a threshold. So we use the age of 100. Okay. It doesn't mean at age 100 we're going to come and tell you need to leave. It's just a number that, for the threshold, because we need a date, right?
Okay. Yeah.
So the closer you are to your 100th birthday, the more money you would get. And the younger you are, we would expect that you would live longer, so you may get a little bit less money.
I see. So it's a bit of a sliding scale, but certainly you're going to tap into a large portion of what you have in equity in the house to do kind of whatever you want to do with it, right? You can
absolutely,
help somebody else buy a home, or you could keep it in the bank, or whatever it is. You could buy some income property.
Absolutely. Or you can just keep it there. A lot of people don't particularly have long-term care. And even my brother said that he had long-term care for many, many years. It kept on going up, and he just didn't want to do it anymore.
Right.
So what you can do is, the younger you are, you take out the reverse mortgage, leave the money there, let the line of credit grow with these high interest rates. It's going to do best for you. And then when you need long-term care, guess what? You can tap into that money.
Yeah, that's a pretty good idea. Now, what you're talking about is you take a lump sum out but leave it in there, or you just do...
Right. Well, let's say, you'd have access to, let's say, 500,000, right? Whatever the number is. And let's say you just don't use it. You want to put that money away for 10, 15 years from now. Well, you let that money grow for 10 or 15 years, it's going to turn into quite a bit of change.
Right.
You know, we can always run numbers for you to show you what the line of credit would do.
Oh, I see.
I love that line of credit. It's very, very, very desirable.
And are you locked into that rate too, or at least on the high end?
No, the rates will adjust.
Okay.
Unfortunately, it's an adjustable rate.
I see.
But when the interest rates are high, if you're not taking out money, you're just opening up that line of credit. Guess what? You're not accruing interest on much, right?
Right.
But your line of credit growth rate is very high.
What's the line of credit growth rate? What does that mean?
Well, whatever money you don't use on the adjustable rate sits in the line of credit, kind of like a HELOC, so to speak. It's there for you. However, the amount every month that you can tap into increases.
I see.
Okay. So right now, interest rates are 7%. Your line of credit would be 7%. So if you can almost imagine having $500,000 sitting in an account you can have access to, but when you're not touching it, the amount you can access continues to grow. And right now, it's 7%.
7% a year it grows? Is that what you're saying?
7% on the balance every month, just as if.
Wow.
Yeah, it's really impressive.
That's really impressive. Now, a future date, let's say rates go down. How can someone refinance what they have at an adjustable into something more of a fixed? Would you then have to go for a lump sum payout?
Yes. If you were to switch into the fixed rate, it would be a lump sum payout.
Oh, excellent.
But remember, on the adjustable rates, when the interest rates go down, your rate will go down, right? And then if you have a fixed rate, if interest rates go down, you have to refinance to come out of it.
Right. Okay. Well, you have a lot of different great options here. I know that you also do purchase reverses, right?
Yes.
Which a lot of people don't understand. We have about a minute left. If you could quickly just tell us what that is.
Sure. Based upon your age, we'll run the calculation. So let's say you buy a house for $1 million. Maybe you have to come in with, let's say $600,000. We're going to give you a loan for $400,000.
Okay.
That's it. It's all the same benefits as if you just paid cash. You'll pay taxes, insurance on your own, and the loan that we gave you will have a little kitty or deferred interest until the time you sell the home or you pass.
Right.
And then the loan is due.
Okay.
In a nutshell.
Wow. That's a lot of info right there in about 10 minutes. Thanks, Nina, for doing that. I really appreciate that. Hey, let people know how they might be able to get in touch with you. This is a great product. I know I was acting as if I was a neophyte, knew nothing, but that's what a lot of people do. They don't know what reverse is, so acting like that is good.
And the thing is, Jeff, we got to give people information. If we give people information, then you can make a decision, right?
Right. No, that's what the show's about, and I do appreciate that. Let them know how they can get in touch with you, if you would, please.
You can definitely call or text me at 480-635-2410, or email me at nhpenny.
Are you there? We lost Nina. How is that possible? She was just about to give us the email address.
Oh, do you have me now?
Yeah, I got you now. Go ahead.
Okay, so email is nhpenny@msn.com, and my phone or text is 480-635-2410.
Nina, thank you very much. Always love having you on.
Thank you, Jeff.
Okay, that's Nina Penny from, you with Malibu Funding?
Yes, I am.
Nina Penny at Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll see you next time. Thank you.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
KCAA, where every day is a great day.
This segment brought to you by Habitat for Humanity. Habitat presents Hops for Houses at the Ritual Brewing Company this Wednesday, June 26th from 6 to 9 p.m. And it's all for just $20. It's at 1315 Research Drive in Redlands. That's 1350 Research Drive in Redlands. It's the Ritual Brewing Company. Come join Habitat for Humanity for a fun-filled evening where they'll be raising funds for a great cause. Enjoy a variety of craft beers, delicious food, and live music while supporting efforts to build homes for those in need in this area. It's a fantastic opportunity to socialize, network, relax, and make a positive impact in our community. So don't miss out on this exciting event. Make your life fun. Wednesday, June 26th from 6 to 9 p.m. Hops for Humanity, Hops for Houses. It's Habitat for Humanity. It's at 1315 Research Drive in Redlands. It's the Ritual Brewing Company. Be there and let's build houses together for Habitat for Humanity. Make your life fun.